start, and if more people enter, I'll just mention that. I'll mention that when I give the first letter. As you know, the regulations were enacted in 2020, but they're just beginning to be decided. Cases are being decided, rulings are being decided regarding those. So I'm going to talk a little bit we're going to basically be following the outline. Some of the material does get a little bit complicated, but we're going to be basically following the outline. And we have time, so if you have questions, there's something on the bottom of your screen, questions and answers. Please feel free to type in a question, and I can either unmute the question or I can answer the question. And so we will, and then you can also raise your hand if for any reason, if you'd like to ask a question, I can unmute you. So we do have time. Someone else just entered. I'm going to mention again briefly, welcome to the lecture. The polling will be a series of letters, which you need to write down during the lecture. And at the end of the lecture, for the completion certificate, just write down the string of letters, and that will verify your attendance when you send your certificate to me. So on page 1, briefly, I mentioned the Tax Cuts and Jobs Act, the evolution of Section 1031. I'm not going to spend a lot of time on that, but there have been a lot of notable changes since the late 70s, beginning with the Starker case. Before the Starker case, in fact, for the entire history of Section 1031, exchanges needed to be simultaneous. Starker, people started to use parking arrangements, and Starker, which was decided by the Ninth Circuit in 1979, that kind of gave the impetus to even more imaginative parking arrangements. But the Starker case basically said that the exchange did not need to be simultaneous. So after that was decided by the Ninth Circuit, Congress enacted the 45 and 180-day deferred exchange periods. Those are put into the statute. Then following that, in 1991, you're all familiar with the deferred exchange regulations. Those were enacted in 1991. And since then, there had been calls for the abolishment of Section 1031, for its repeal, throughout the 2000s and 2010s, 2020s. Nothing ever happened. But in fact, the IRS has been very, very lenient and has made Section 1031 more of a useful statutory provision for those seeking to exchange interests, because tenancy and common interests were made available for replacement properties in 2002 via Revenue Procedure 2022. It gives many guidelines, so that you can avoid partnership status, because, as you know, partnerships could never be exchanged in 1031 exchanges. So there were guidelines. And then, as you know, I gave a lecture a couple of months ago about Delaware statutory trusts. Those are now much more popular than tenancy and common interests for many reasons. They're simpler. The requirements for the lending are much simpler. The person who purchases an interest doesn't have any requirements. But this lecture is not about Delaware statutory trust. But if you are interested, I commend you to an outline that I prepared for that lecture. It's on my website. President Obama sought to repeal Section 1031. President Trump did repeal it partially, to the extent that personal property was no longer allowed. President Biden has sought to eliminate it in his short tenure, but he was also unsuccessful. He also sought to eliminate Revenue Ruling 8513, which was the basis for sales to grantor trusts. Also, it was the basis for the Delaware statutory trust Revenue Ruling 2004-86. So if 8513 had been eliminated, that would have taken with it many other things, but those never saw the light of day, those changes. But the Tax Act of 2017 did make the change that under the Trump administration. By the way, the Trump administration sold the act to Republicans who were reluctant to support it by saying that the bonus depreciation would be a surrogate, a proxy for it. So they bought that, and the and 1031 was amended to exclude personal property. I don't think many people envision 1031 to be further limited during Trump's second administration. I just don't think that's going to happen, no matter what happens with the budget. So I think that 1031 is safe for now. But the 1030, the TCJA, the legislative history stated that anything that was real property before continued to be real property after, and anything that was that wasn't real property continued to be excluded. So that rule is the bedrock, and the other bedrock of the rule. Well, that wasn't the bedrock of the rule. That came later in the regulations. The bedrock of the regulations added to that, and what it did was it reestablished the primacy of state law. So it opened up quite a few ways that you can qualify under Section 1031, many of which included ways that personal property that was excluded can now be rehabilitated or brought back into, I say clawed back, but you can use any adjective you want, but brought back into 1031's province, so to speak, by the somewhat complex rules in the regulations, which we'll get into. I think we're going to mention, and for the gentleman who was not here, or for the woman who was not here, for the woman who's not here, gentlewoman who's not here, they're going to be, I'm going to give there are going to be 5 letters during the lecture. The first of which is E as in Edward. You should write that down, and when you request your certificate, just write down the string of letters. And if you have to leave, then try to leave briefly, so you don't miss that. Anyway, I assume that there are no problems so far. If there are any, please raise your hand, or you can use the question and answer, as I said, to ask a question. So we're on page, I'm looking at page 6 now, and let's talk about the final regulations. Final regulations were published in 2020, 6 months after the proposed regulations, which were widely criticized. And they were retained in part, but rejected in part. And when I say rejected, they were really rejected. The backlash against some of the things that the proposed regulations stated was fierce. But anyway, what the final regulations established was that you look to state law for purposes of determining what's real property. So anything that is real property, except things that were excluded, and it's a little bit cloudy as to exactly what applies. Certainly, it's anything that was. There are the reason I say it's a little bit cloudy because there weren't that many things that were, except for the things in 1031 that were personal property, intangible interests that were excluded. Those continued to be excluded, and there were some attempts even to challenge that by saying that if state law said that those were real property, would those now qualify as real property? The answer is no. Anything that was excluded under the statute remains excluded. But in any event, as I said, many assets that were never real property now became real property. So the loss of the personal property was in a way modified or improved. So property, an asset, let's call them assets. An asset could qualify as real property if it was defined under state law, or if it qualified before the 2017 Tax Act. Now, if it didn't qualify under state law, you can look to state law first, because then your inquiry ends. But if it didn't qualify under state law, then you can look to the structure enacted not enacted, but it was published or issued in the regulations. I say it wasn't enacted because it's not a statute, but it was the view of Treasury. And there were a lot of comments to the final after the proposed regulations, and there were comments for the final regulations, and they were well thought out, but they are kind of abstruse. But basically, I'm going to explain in simple terms, and if we have time, we can get into more complicated analysis of it. But in simple terms, improvements to land or improvements to land are real property by definition, and that you don't have to look any further than that. If you have, and the way that the final regulations, and they're in your supplement, but I don't think you need to refer to them now. But the way that the final regulations characterize real property or assets as real property is they first look to whether it's an inherently permanent structure. And those would be things like an inherently permanent structure would be a building, something enclosed with 4 walls and a roof. So it would be a mall, a house, an office building, something like that, an enclosed stadium. And some of them, the regulations actually list some of them. Some of them aren't listed. And if they're not listed, they're called non-listed assets. And there's a test for non-listed assets. And if it's not an inherently permanent structure, there are other things that are quasi-inherently permanent structures, but they're not really, because they don't have a roof, they don't have 4 walls, and those are called other inherently permanent structures. Things like that would be many other very heavy permanent objects, such as, or things like bridges, tunnels, things like that. And there's also a test, and I give the example of Yankee Stadium also as an other inherently permanent structure. If you had an enclosed stadium, that's actually a listed inherently permanent structure. Yankee Stadium would be an other inherently permanent structure because it doesn't have a roof and it's not 4 walls. So it's an other inherently permanent structure, but it's not listed. They list, the regulations list certain structures for inherently permanent structures and other inherently permanent structures. And if it's not on the list, there's a test. Yankee Stadium would we're going to get into what the tests are, but not yet. Yankee Stadium would qualify. So it would be a non-listed other inherently permanent structure. And then we get to the interesting part, because things that never qualified, or probably never qualified as real property, would now qualify under the regulations. And those are called structural components of inherently permanent structures. And we'll get into that. And that's really, that means that if you have an inherently permanent structure, say you have an industrial warehouse, and you have a pipeline that's supplying it with gas, then you would, if it's integrated into, and it's a structural, if the pipeline is integrated into, and it's a structural component of the of what's in the industrial building, a generator or something like that, they use the regulations use a generator, then that it qualifies as real property. So that's what I mean that when I say that some assets that were never real property can become real property under the final regulations. And intangible property as well. If it was always real property, then it's still real property. If state law defines it as real property under the final regulations, it's real property. but most of the intangible rules were already pretty well embedded in the law. So you're not going to see many things that rise to the level of real property by reason of the final regulations. Those were pretty much taken care of. But there is an exception. There is an exception to the rule that intangible property, for intangible property to constitute real property, because obviously not all intangible, we know some isn't. The exclusions for partnership interests, certificates of trust, and by the way, Delaware statutory trust bypassed the requirement of certificates of trust. That was the whole purpose of revenue ruling 2004-86. But in any event, the main purpose was then to define what the intangible property was, and it has to be related to the real estate. It has to have a nexus to the real estate. So a lease, an easement. And by the way, the length of the easement doesn't matter. That's only for purposes, and that's only for purposes of whether it's of like kind. Remember that for a 1031 exchange to work, it's not only required to be real property now. Both the replacement and the relinquished property have to be of like kind. And that was, with real property, it was often said that was very easy. And it wasn't a very big consideration. It gains a little bit more prominence now that other things like structural components now enter the fray. So I wouldn't say it's always a no-brainer. Sometimes you have to really look at it, and we'll look at some revenue rulings that address that. But there is an exception for intangible assets that would otherwise constitute real property, and that's an example in the regulations, which we'll get to. But I see that there are no questions so far. Let's go to the second letter, and that will be T as in Tom. Okay, so that's the second one. And I'm going to just cross them out on my own paper so that I know. Okay, so we still have well over an hour, about an hour, so we're making good progress. So what happens when two states, I'm on page 8 of the outline now, if two states characterize an asset differently, what is the result? Well, the result could be that the federal law says that, okay, well, since one state says that it's real property, we're going to go with that one state, and that one state's going to prevail. Or we're going to go with the other state, the state that says it's not going to prevail. And it's neither of those. What happens is the final regulations say, we're going to look at our classification method. So we're going to go and we're going to see whether it's an inherently permanent structure or whether it's an other inherently permanent structure. And by the way, a structural component can be real property, but a structural component, let's look at a pipeline supplying a generator in a building. Okay, so then if it's integrated into and it's a structural component and all the requirements of the if it's a listed structural component, then you don't have to worry about another test. As I alluded to earlier, there are other tests for things that aren't listed because obviously the regulations couldn't list everything. But if you have a structural component that's not listed, then there's a test for it. So if you have a structural component that's not listed, you need to ensure that it's integrated into, and there's an example that's showing this. We'll get to it possibly, but it has to be integrated into a component part of something larger, a generator or something like that, or a 3D printer. And if it's not real property. And the corollary of that is that if you have a pipe sitting in a FedEx warehouse being ready to be shipped to the company to Con Ed for one of their generators, it might become real property at such point as when it's installed, but sitting in a FedEx office, it's not real property. And by the way, an example of real property, and it's an interesting example, it's in the regulations. It speaks of a 5-ton structure, 5-ton sculpture that was created, and it was embedded into the building foundation. It can't be moved. It would destroy the structure and the building, all kinds of horrors. That's considered real property under the new classification. It gives you a taste of some things that can now be considered real property. And generally, the general tone of something, and forgetting about structural components for the moment, but the general tone and tenor of the regulations with respect to what constitutes real property is it permanent? Is it permanently affixed? Affixation can be accomplished by weight alone. And those are basically the basic requirements. The difficulty in removing it, the difficulty in installing it, things like that. Those are things that would embellish it for purposes of making of it passing one of the tests. Okay. Okay. Well, another thing that the final regulations changed, they eliminated the purpose or use test. Under the proposed regulations, which I indicated were severely criticized, and I'm on page 9, bottom of page 9, tangible property could not be real property if it contributed to the production of income, quote, unrelated to the use or occupancy of the space. So it couldn't be real property if it was unrelated to the use or occupancy of the space. There was some criticism, a lot of criticism of that, and that was eliminated. So that no longer applies. Whether it contributes to the production of income, and even if it's unrelated to the use or occupancy of the space, that's no longer relevant. So if we had that Con Ed situation where there's a generator and you have some pipelines going in, and the pipelines don't benefit, well, say it's not Con Ed, say it's Amazon. And the pipelines don't benefit Amazon. They benefit some other tenant. That requirement is no longer important. It's no longer there. It's no longer matters. It doesn't matter. It doesn't need to be. It can be unrelated to the use or occupancy of the space. But as I mentioned, as I did mention briefly, the purpose does remain relevant with respect to some intangible property. Now, I'm on page 10, and that speaks about, there's an example 12 in the final regulations, which you have in your supplement. You don't need to turn to it now, but it's there if you want to look at it. It speaks of a license granted to a casino to operate in a particular building. Now, the license can't be transferred to another location. So the example concludes that it's not for the use, enjoyment, or occupation of the building, but that doesn't matter. Even though the rule was amended, it was abrogated. That rule was abrogated. It's still not real property because it's to operate the casino business in the building. And I thought long and hard about this, and it's difficult to differentiate this, but somehow the fact that it's not transferable and it's being used to operate a business, that disqualifies it, and that comes up in the casino example. And the casino example also came up in the proposed regulations for its. Interestingly, the casino also came up in the proposed regulations, which were not really, which were not carried over to the final ones. But the proposed regulations also held that it didn't qualify as property. So, and I give an example. All right, and then there on page 11, there's an example, a good example, because it indicates, I'm not going to go through it verbatim, but little 3i on page 11, that you have one situation where it's defined under state law, and the other situation where it qualifies under the new classification system with inherently permanent structures and other inherently permanent structures, listed and unlisted. And I mention again that there, with respect to inherently permanent structures, other inherently permanent structures, and structural components of inherently permanent structures. Some are listed for each, and some are not listed. And there are tests for each. Actually, there's only two tests, one for inherently permanent structures and one for other inherently permanent structures. There's also a real property test for structural components. And those are on in the outline. We may get to those tests if there's time, but they're in the outline. And the test basically embellished the basic requirements. So for an inherently permanent structure, you need permanent affixation, difficulty in removal, whether it was installed during when the building was installed, and for the test for non-listed ones just basically asks those same questions in greater detail. Okay, and also a note on the like-kind requirement. As I mentioned, the like-kind requirement is the second part of the equation for like-kind exchanges that needs to be met. It's not addressed in the proposed regulations. In the final regulations. The final regulations state that it's, quote, beyond the scope, and it is, because it's a whole area of law which has evolved. And but again, it's a completely different inquiry than whether something's real property. That's the first hurdle. And it was always said that the real property like kind is easy, but it's not easy anymore. I'll give you a quick example. Suppose you have a building, an office building, and you're exchanging it with something that has a structural component or many structural components, like say a nuclear reactor facility that's composed of many structural components. There may be situations where you need to look at whether the real properties are of like kind because of the existence of because of the presence of the structural components. And the regulations don't really address that. So it may not be as easy to qualify properties as like kind anymore. And by the way, whether properties are of like kind depends on whether they're of the same nature or character. And those are concepts that actually it's on page 13 in the other font, not in the set off. It depends on the nature or character of the property and not to its greater quality. But in any event, it's not covered. It's not covered really in the final regulations. But again, as I said on page 14, the real property always enjoyed rarefied status, but it's a little bit trickier now. But the duration, as I mentioned, the duration of an easement or a leasehold, which may be relevant for purposes of whether it's like kind, that has no relevance according to the regulations for purposes of whether it is or is not real property. Okay, so I mentioned on page 15, I mentioned the problem of Yankee Stadium not being of like Yankee Stadium is an other inherently permanent property. I'm on the example in one little I. It's obviously it's not of like kind to an oil and gas pipeline, even though Yankee Stadium qualifies as real property as a non-listed other inherently permanent structure, and the oil and gas pipeline qualifies as real property if it's structurally connected and integrated into an inherently permanent structure. Okay, so okay, let's talk about the incidental personal property rule. And how much time do we have? Okay, we're still okay with time. It was thought that since personal property no longer qualified, and I see there are still no questions, correct me if I'm wrong. Okay. And I assume that's because there are none, not because I haven't explained how you can ask one. But you can ask one by pressing the questions thing and typing it in. So anyway, there was concern that under the deferred exchange regulations, there are several legal fictions that were established, because otherwise, if those weren't established, you couldn't proceed with the deferred exchange. You'd violate the agency rule, you'd violate escrow rules. So there are legal fictions. There was concern, though, after personal property, was excluded from like-kind exchange. Many buildings, and buildings are common, common assets that are used in like-kind exchanges. Many buildings do contain personal property, desks, things like that. And, you know, any real property, building or structure, office building, industrial, it's going to have some personal property. There was a concern that when the property was purchased by the QI, the funds go in. When the relinquished property is relinquished, the funds go into the QI. It was a concern that the QI, the qualified intermediary, was going to use some of those funds to acquire a building that contained personal property. And that the concern was that that would be a violation of the rule that the QI cannot use any of the escrow funds to purchase property that didn't qualify in the exchange. Now, this was never a problem before personal property was eliminated because personal property qualified. But now that personal property no longer qualified, there was that concern. And the way that the final regulations address that concern is by saying, okay, we understand that that's a problem. We're gonna create a legal fiction. They don't use the term legal fiction. That's the term I'm using, but that's what it is. We're gonna create a legal fiction. You can use escrow funds to acquire real property, and that's not going to imperil the like-kind exchange, provided that and I'm on page 16, the property would be included in standard commercial transactions. The personal property would be included in standard commercial transactions, which basically means very little. It has a very narrow application because they later say that the discussion in the regulations say that basically it can't be for personal use. So it's really, but it does mean something, but it doesn't, the restriction isn't that great. But the other restriction is it can't constitute more than 15% of the value of all the real property replaced, all the replacement real property. So that could be a problem. If you have, and by the way, the personal property is not considered part of the denominator. So the personal property is out. And so if you acquire $150,000 of personal property and the real property is $1 million, then you just meet the limit. But if the 150,000 were included, then you'd meet the limit. You wouldn't touch up against the limit, but it's not included. It's included just in the amount, the top, I guess, the numerator, people would say, right? So the definition of commercial transactions is on page 17, and that transactions involving business or investment property rather than personal use property. So, but in order for it to mean something, I think that you wouldn't want to include as personal property. Say you were, Amazon was exchanging, and I say Amazon because it's been brainwashed into me from the Delaware Statutory Trust lecture. But say an investor was exchanging real property for other property that contained 20% or 15%. Let's say it was 15%, but 15% of personal property, but some of the personal property was a car because the car is personal property. I wouldn't do that because even though it meets the 15% limit, it's clearly not related to the building, and you don't want to run into problems. So, but so the 15% is also, there were some questions about the 15% limit, whether it was a bright line, whether it was a safe harbor, whether it was a guideline. The Treasury danced on that really, and it was fairly. It just said, look, we're going to look at all the facts and circumstances. So it's not a bright line. So you could probably go over it, and no one would raise an eyebrow a little bit. I don't think if you went to 16%, Anyone would care, really, as long, I mean, if it was if it was some clearly related to it. And I use in the example, I have my own hypothetical, which was an example of someone acquiring a racetrack and a casino and the licenses. Now, remember, we spoke about the licenses earlier. The licenses were an exception for intangible property because they were a business use related to the real property. So they don't qualify as real property, but they come close. So if you had 15% of personal property, for the casino, all the one-armed bandits and machines and everything else, I don't see how that could be anywhere close to 15%. But in any event, let's assume that there could be, for the racetrack and the casino, you had 15% of personal property. And you also had those two licenses, those two business licenses that don't qualify as intangible, as real property, because they're unique to that racetrack and they can't be transferred. So then you're at 20%. So you could make an argument that you can't make an argument that you didn't exceed the 15%. So you could have a problem there. However, even if the IRS were to argue that you have a problem, what you can do is you can take the licenses, the two licenses, and have the purchaser of the racetracks and the casino buy them with cash. So now now you don't have the G6 problem. You don't really technically have the 15% problem. Now, what's the IRS going to do in that case? Are they going to come back and say you violate the economic substance rule, you violate the business purpose rule? I don't think those arguments would carry much weight. For this reason, if you're saying that you can't buy something, personal property, especially if it's related to it, you're really treating the personal property worse than you're treating boot in an exchange. So that doesn't make a lot of sense. So I think that as long as I'm not giving legal advice, obviously. I wouldn't, these are new regulations, but I also cite, and I don't know where the footnote is, but in the area of whether let's go to the third letter for the polling. That's C. C is in Charles. So we've done 3 now, and we still have some time left. So you have I think you would have a reasonable argument, because I think it's revenue ruling 2021 something, where you're talking about whether something is a true lease or it's a purchase. And the rule was that you have to have at least an investment of 20% throughout the period of ownership. But there's law that says that that's a guideline. Here you have something where the IRS, the Treasury, has said we're going to look at all the facts and circumstances. Now, taken to an extreme, the IRS also says, or the Treasury also says, that their concern was in response to why the 15% rule wasn't higher. Their response was they don't want taxpayers bundling into exchanges personal property that wasn't intended to. They don't want to augment the class of personal property in exchanges. So you have a tension. So I think that you need to be careful, but I think that if you're over the 15% rule, and especially if the property is closely related to the purpose of the replacement property, then I think that you have a stronger case. I'm not saying that you would win. And as far as disclosure goes, the new economic substance doctrine statute, and it's becoming more. The cases are now being decided. The IRS is using it more. It would be hard, in my opinion, to make that argument in some of these cases, because what we're talking about is qualification under a statute that was enacted by Congress and the taxpayer is seeking to qualify under it. And I can understand, and we'll talk about some of the cases where it involve related party exchanges and basis shifting, where taxpayers made use of net operating losses in order to avoid gain under 1031 exchanges. That to me is a different dimension. That's a different that I can see that being more objectionable, but merely buying property in a separate transaction for cash, it doesn't strike me as having the same kind of negative connotation as some of the other ones. And also, if you did do that, you might be able to you will need new cash if you use a separate transaction. But if you with post-exchange financing or pre-exchange financing, it might be possible to just take the cash out and then put it back in after the exchange, assuming there's a business purpose. Okay, another rule is that I'm on page 18. It's the 15% rule is not a safe harbor, but it doesn't, and on page 19, doesn't apply on a property basis. As you're aware, you can identify up to 3 properties, or under the 200% rule, any number of properties. You don't have to worry about the 15% rule when you're doing the identification. So you can identify, say you identify 3 properties. You don't have to worry about, it has nothing to do with the identification rule per se. However, the way that you calculate the percentage, the 15%, is by aggregating all the personal properties, the fair value. So you can, if one of them is 20% and they're all equal value, equal fair market value, one of them you identify or you acquire is 20%, the other 2 are 10%. So you're below 15%, you're okay. However, as I mentioned in my outline, it occurred to me that if it turns out that you're over, you identify 3 properties and you come out to 16%, because 2 of them are 14% and one of them is 20% or whatever. The IRS could make the argument that you violate the rule and all of them therefore don't qualify under Section 1031. They could make that argument. It's not without logic. So I'd be careful with that rule also. And by the way, the rule it applies to the aggregate number, but the identification rules still apply. So if you meet the 15%, each property doesn't have to be separately identified, only when it's more than 15%. So in other words, I should have mentioned earlier, I apologize. The 15% rule always existed, but it existed for a different purpose, because there were always limits to how much personal property, but it was never a question of whether it was never there. You might have tried to balance the personal property and the relinquished property and the replacement property, but that would have been for a different reason. And that would, well, actually, it would have been for 1031 also, but it would have been because you could have situations where you could have ordinary income recapture. So, but it wouldn't be boot. By the way, the 15%, needless to say, the 15%, even if it qualifies under the legal fiction, and it's not going to, it's not going to imperil the exchange. Obviously, it's still boot. It's going to be taxed as boot, which is again the reason why I don't think it makes such a big difference if you enter into a separate transaction for cash, because it's still going to be taxed as boot. Okay, we've talked about the scope of commercial transactions. We've talked about the hypothetical. We've talked about the use of cash on page 23 to avoid the G6 issue. Violation of economic substance doctrine. Okay, so let's talk a little bit about, let's go back to the, okay, there's one element that we have not discussed with the inherently permanent structure, other inherently permanent structure, structural component of inherently permanent structure. And by the way, they don't have I haven't seen structural components of other inherently permanent structures. I don't know why that is. Maybe because it's you wouldn't really have and other inherently permanent structures are sometimes floors or walls or things like that. You're not, it's hard to imagine a structural component of a floor. So anyway, it's just a structural component of an inherently permanent structure. But they have, as I said, they have tests, real property tests for that. And there's another one, distinct asset. Every real property set must be a distinct asset, structural component, inherently permanent structure, or other inherently permanent structure. Nothing can be real property unless it's a distinct asset. And what that means is, although it doesn't really, you don't have to worry about it occurring very often, something could be no, something can't be a listed asset. A listed asset is per se a distinct asset. But a non-listed asset, and so is a non-listed. Basically, almost everything is a distinct asset. The only thing that's not a distinct asset are non-listed structural components. Those are the only listed structural components are distinct assets too. And the regulations, the final regulations state that everything, all real property must be a distinct asset. I'm on page 26 now. And it's one of those situations where the regulations don't go to a lot of effort, maybe they should have, of really saying what a distinct asset is, but they just say what it needs to do. They kind of dance around the actual definition. But a distinct asset, you know, let's look at the qualifications for the, and that will give you an idea of what a distinct asset is. So as I said, all real property, all listed real property, and unlisted real property are distinct assets. And I'm sorry, all inherently permanent property, listed or unlisted, is a distinct asset. The only thing it's not is a structural component. So on page 34, there is a test for structural components. A qualification test for a structural component to be a distinct asset. And one of the requirements is that it's customarily sold as a single unit. Okay, so it's distinct. It's sold as a single unit, not costly to separate from the larger unit. That's factor 2. 3, it has a useful independent function. And 4, it does not removing it wouldn't impair the function of the larger asset. So that's the only time it comes up. Anything else is a distinct asset. And by the way, as I think I mentioned, but I'll reinforce it if I didn't, or I'll state it if I didn't. Listed assets are per se either inherently permanent structures, other inherently permanent structures, or structural components. And actually, other inherently permanent structures and inherently permanent structures are also per se distinct assets. So you don't really have to worry about distinct assets very much. What comprises them? Okay, so we talked about on page 27 inherently permanent structures, buildings, and listed examples of inherently permanent structures. We talked about other inherently permanent structures, the importance of affixation. It needs to be either permanently affixed. Affixation can be accomplished by weight alone for an other inherently permanent structure. I don't think it would really apply to a building, an inherently permanent structure, but for another one, like that sculpture in the atrium of building lobby, that's well, that one was actually bolted in. But if it weren't bolted in, it could have been by weight alone. But on page 29, let's look at the real property qualification test for non-listed inherently permanent structures and other inherently permanent structures. So these are things that are non-listed. Okay, the manner in which we look at the manner in which the asset is affixed to the real property, whether the distinct asset is designed to be removed or to remain in place. And these will take on more color when we go through some examples. We still have some time left. Okay, and the time and expense required to move the distinct asset. We talked on page 30, we talked about the indoor sculpture that passes the test because it's permanently affixed. It was put in when the building was made. Let's look at B on page 31, bus shelters. These were removable. And I'm going to cut right to the chase since time is beginning to be more important in our situation here. But they could be removed, and that's the reason that they're not considered real property. Fails the test. They're not permanently affixed. They're not inherently permanent structures, and they weren't listed, but they needed to qualify under the test, and they don't. So let's go to structural components of inherently permanent structures on page 32. Here, you have some listed structural components in 10A, those walls, partitions, doors. The listed ones are distinct assets and they're real property per se. You don't have to worry about those. For the non-listed ones, which are going to be most, not every, I can think of a million, I can't think of, but I'm sure there are a million structural components that aren't listed. You look at the manner, time, and in which the distinct asset is affixed to real property, no, I'm sorry. You look at the manner, time, and expense of installing and removing the component. I'm looking at different notes, and if it's costly to install and remove, that would lend credence to its being qualifying as a structural component. Not designed. Is it designed to be moved? No, it shouldn't be designed to be removed. And the removal, factor 3, the removal would damage it and would damage the other item, and installed during construction. So those are the good factors. Now you don't have to qualify property, a structural component, or an inherently permanent structure, or an other inherently permanent structure. You don't have to qualify under all the factors. They're factors, and in some of the examples, as we'll see, there are some of the factors weigh in favor, and some do not. Okay, so we talked about distinct assets. As I mentioned with the nuclear reactor, you could have many distinct assets. And in D on page 33, the regulations state that if interconnected assets work together to serve an inherently permanent structure, the assets are analyzed together as one distinct asset. So we have that. There is, as I said, some lack of clarity as to what exactly that means, but and how exactly that's going to affect the future of these qualifications. On page 35, we have a 3D printer. That passes as a structural component. This was installed in the building. It's a 3D printer that prints airplane parts, wings. I don't know even if that's technologically possible, but this is the example that they give. But it weighs 12 tons, and it's considered a structural component, and it passes the test because it's on page 36. It would be time consuming and costly to remove. It's not designed to be moved. It would damage the building, and it was installed during the building's construction. And this, as I say, in 2 little I on page 36, this is an example of where machinery has been elevated to the status of real property under the final regulations. So again, we have the state, and we have the possibility of basically machinery and parts, structural parts, and also some other things like that structure in the atrium of the lobby. These things would not have been real property, I believe, before. Almost certain that wouldn't have been real property before the regulations. Raised flooring on page 37. That's not a structural component, although it's not listed as a structural component. So we have to go to the test. Actually, we don't even get to the test because remember, one of the components of a structural component is that it needs to be inherent. It has to be integrated into and a component part of it. It fails that test. It doesn't, it fails that test. So it's not a flooring as listed. Flooring is a listed structural component, but it's not flooring as listed. So we don't even get to there. But if we did get to the test, by the way, all these examples that they give, they ignore the like kind requirement. I guess they're assuming that some of these examples have mentioned like kind. But anyway, on too little I on page 38, they just state why it doesn't, they don't qualify, why it's not a structural component. Page 39, we have a steam turbine, which is, I alluded to that earlier. It was installed on C on page 39. It was installed during the building's construction, and removal would be costly. So you have the permanency of affixation, the difficulty in removing it, the cost and expense of removing it. These are all factors which tend to show. Then example 8, you have partitions, you have permanent partitions, and you also have situations where there are modular partitions. The modular partitions, the permanent partitions, are real property because they were installed during the building's construction. They can't be removed very easily, and they're both distinct assets. And again, everything has to be a distinct asset. The partition system, the conventional one, and they will stay there even if the tenant vacates. The modular system, on the other hand, it's not real property because on page 40, because it's typically removed when a tenant vacates. And they're not designed, or too little I, they're not designed or constructed to remain permanently in place, but rather to be movable. Okay, and then there's an example 9, pipeline transmission system. And the pipelines, the oil and gas pipelines, they're real property. So they're listed. They're listed structural components, they're listed. And then on page 41, there are isolation valves and vents. These are also listed. These are also not listed, but they qualify under the test because they would be costly to remove, etc. Difficult designed, and they're not designed to be moved. But the meters and compressors on the bottom, they don't qualify because unlike other meters and compressors, these particular meters and compressors are not time consuming to install and remove and are not designed to specifically for the pipelines used and would cause no damage if removed. Okay, so let's talk a little bit about intangible assets, and I'm going to give you the fourth letter now. F, fourth letter in our series is F as in Frank again. Just put these on the certificate when you email it to me, sign it, email it. I'll send you back the digits code that you can put it on so that I have what I need and you'll have what you need. So anyway, unsevered natural products of land, page 42, number 13. These were these growing plants, crops, timber, mines, wells, other natural deposits. But once they're removed, once they're cut, so if you have a cornfield, the corn is harvested, then it's no longer real property. But it is until it's harvested. I mean, there's an example. A owns land with perennial fruit-bearing plants that A harvests annually. The unsevered plants are natural products of land and are thus real property. And upon severance from the land, the harvested fruit ceases to be part of the land and therefore it's not real property. So this plays into the timing issues. If you have timber, something like that, and there are exchanges of that, it could affect the qualification under 1031, obviously. Okay, so intangible on 14, we've touched on this, but let's take a closer look at it. The Act eliminated the ability to exchange intangible personal property such as patents or copyrights because those were in the exclusions. But regardless of whether they were I believe they were excluded, as were partnership interests. And they're not considered, and they don't qualify. However, other things that are intangible property under state law, they do qualify. But again, with respect to intangible property, the purpose of it can make a difference with, as you saw with the casino racetrack situation with the licenses. Even though the purpose or use test, I guess, with the purpose or use test, when it applies to income, the use of it when it's with respect to any income situation, that was eliminated, but it wasn't. But the purpose test wasn't eliminated with respect to the use when the use is of business property, and that's the problem. That the purpose can still be relevant in some cases, so you just need to keep that in mind. So qualifying intangible assets on page 43. This would include some. This is mostly a product of revenue rulings. Real estate for ranches or farms, leaseholds of 30 years or more. By the way, options are now qualify as real property. But if you have a temporal aspect, an option to acquire real property might not be of like kind to an option to acquire real property in 10 years, even though they're both real property. But that goes into the like kind qualification issue. And as I mentioned before, they're completely separate endeavors. You first have to find out if it's real property, and they both might be real property, but they might not qualify as being of like kind. And the Tax Act and the new regulations make the like kind inquiry much more substantive than it was. On page 43, the bottom, state law has no relevance in the like kind determination. It never had any relevance, and it never did. It does have relevance in determining whether something is real property. We know that. If state law says an intangible property or other property is real property, it is, except if it were not real property before the Tax Act, or if it was excluded. But state law is dominant there, but it doesn't have any input into whether properties are of like kind. None, except corollary tangential. Fee ownership and co-ownership, page 44. These are just things that intangible interests that qualify as real property. Nothing new here. Co-op shares, there was a ruling with respect to some New York co-ops. Those do qualify as real property, which is good because you can almost see how they could be excluded because they are, an intangible thing, kind of close to a certificate of trust type of thing, but they qualify. Licenses and permits, leases and easements, these qualifying options qualify. Okay, so now we're going to get into some cases. Page 46, it's also in your materials. This case with Gluck versus Commissioner, it was an interesting case because Gluck was a real estate attorney, a practicing real estate attorney, and he exchanged, or he did exchange, and it was a good exchange. He exchanged well, it wasn't a good exchange. He thought it was a good exchange. He believed it was a good exchange. He exchanged a $10.2 million New York condo for what later turned out to be a tenancy in common. There was evidence in the record, I think it's fair to say there was, that he wasn't aware, he wasn't careful about what he acquired. And it's tenancy in common interests are difficult to avoid. If you have property that's split up into 5 tenancy in common interests, it's difficult to avoid partnership status under federal tax law. Very difficult. You basically can't do anything. And that was the rationale, the raison d'etre for Revenue Procedure 2002-22, when it allowed certain tenancy and common interest to qualify, there were a bevy of rules that you needed to qualify, restrictions and other things. That was for purposes of getting an advanced ruling, and it was very difficult. So even if he believed that it was a tenancy in common interest and not a partnership, which it turned out to be, it would have been difficult. It would have been an uphill struggle. It's very difficult for tenancy in common interest in real estate with 5 partners under state law to qualify under federal tax law. But let's say he didn't. I think it's fair to say he didn't know that it was a partnership. But in any event, he was audited and it went to the tax court, and the commissioner Gluck argued that the tax court had no jurisdiction over the case since it dealt with a partnership issue that the tax court didn't have jurisdiction over. However, the tax court agreed with the commissioner that basically what happened was that the partnership, it turned out that he had exchanged his interest for a partnership, and it didn't qualify under Section 1031. So the tax court said, look, this was not, we didn't need to do any analysis. This did not qualify under the statute. And this, we don't need, basically, the court said that they didn't need jurisdiction. They basically said that it was not an issue under the partnership rules that the taxpayer Gluck had argued. They said this was more or less matter of law. They used the term matter of law. And they said that since it didn't qualify, and moreover, Gluck received a partnership informational return. He received that, and he didn't do anything. He didn't notify the partnership that he didn't contest that the partnership was in fact a partnership, which he could have done. The tax court said he could have done that. Some of the analysis that I've read said that it would have been very difficult for him to get the information because it was inherited property. But the tax court said that he should have filed the Form 8082 and then stated that it wasn't a partnership. He didn't do that. So the court held that it wasn't, excuse me, court upheld the adjustment. It wasn't a deficiency determination, it was an adjustment because it didn't qualify under 1031. And they also upheld the penalty. And they said that they didn't need jurisdiction over the partnership to do that because they only needed jurisdiction over Gluck, which they had. So this was a case where, and they also, although they didn't mention holding Gluck to a higher standard, he was a real estate attorney, but then it might have been difficult for him to get the information. So the teaching of this is that you need to know what you're acquiring. You need to be certain that it's not a partnership interest and it's not a tenancy in common interest. And he wasn't certain about that, I guess. Okay, PLR 2002 on page 47, ending in 008. This was just an exchange of digital currency, which doesn't qualify, but it's just to show the like-kind rules. They said that Ether and Tether were digital pairs, but the like-kind exchanges in issue were not digital pairs, so it didn't qualify. Page 48, PLR 2023, 9007, involved water rights. This is an interesting one. These were water rights along the Colorado River, I guess. I'm assuming that, just to make it sound better. But it probably was some big river, large river in the West. They all had rights, water rights, and what they agreed, there was a written agreement. And let's give the last number here, the last letter. It's M. M is in Mary, or mature. Okay, so we're done with that. So basically, they agreed that if any of the owners sold any of their interest, that they would own a certain amount of the intangible asset. And the court held that that was good. that that was a good exchange because it was of permanent nature. It was a permanent water right. There was another case on page 50, Wykins, which said it wasn't permanent, but it was permanent, and they broke it up. They they divided it, and it qualified. It qualified under. It was not limited to on top of page 50. It wasn't limited to a specific amount of water or for a limited period, and they were sufficiently similar. And he exchanged it. What did he exchange it for? Oh, he exchanged it for something else. But anyway, it was a good exchange because it wasn't. It was changed for other real estate, other qualifying real estate. Okay, so then 5002. The last four letters on page 50, another PLR. I want to get to. We need a few minutes to get to Malulani. This one dealt with, it was a reverse exchange, and it dealt with transfer development rights, and basically cutting to the chase, it held that basically for an intangible property to qualify as real property, it either needs to be something that was real property or it's similar to something that was. And basically it's saying here, this case actually stands for two issues. It stands for two propositions. One is that transfer development rights are property, and also here, the taxpayer's property that he exchanged, the transferable development rights that were received actually related to the property that he relinquished, or that he retained actually. So it was, under a very old case of Coca-Cola versus Commissioner, you can't do a like-kind exchange with yourself. So here, the transferable development rights related to property that he owned afterwards. So it was an interesting case, and you can take a look at the ruling if you'd like. Okay, so let's get to Mololani. Basically, the progenitor of this case was the case of Taruya and then Okamulji. Basically, if you're doing a like-kind exchange, the related party rules provide that the related party can't dispose of it within 2 years. That's clear. What happened in Okamulji, the first case, was that a qualified intermediary was used. And basically, when the qualified intermediary was used, the court held that the taxpayer was just getting around the related party rules by inserting a qualified intermediary. And in that case, the overall tax liability was less than if the taxpayer had not engaged in a 1031 exchange. So the court said you can't use a qualified intermediary to engage in an exchange just to avoid the rules of the related party rules. That was the first one. That was the first one. That was Okamulji. I think Okamulji was the second one. Taruya was the first one. Okamulji was the second one. In Okamulji, they said it was kind of similar, but they said, well, we tried to exchange with an outside. They also use a qualified intermediary. We tried to exchange with an outside party, but we couldn't. So the tax court said no. They looked at the amount of tax that was saved, and they said no good. Finally, in the case that we're looking at, Mololani, it was interesting because here there was no basis shifting. Basis shifting is when, I'm not going to get into it, but it's in the footnote. That had been one of the cardinal things that they were trying to avoid. Here, there wasn't basis shifting, but what happened was they used a qualified intermediary, and they acquired the property from a related party. The related party had NOLs, which eliminated the related party's loss, even though the related party sold its property and it had a low basis. So there was no basis shifting. The Ninth Circuit in this case, which was decided in 2019, held that you don't need, it's not only basis shifting that it's concerned with. It's also they look at the amount of tax saved. So it's different than the casino example. Anyway, I thank you. The seminar is over, and I hope to see you again. And if you have any questions, I'll remain here and I'll let you, I'll let you go on to, I'll unmute you and you can ask any. So I'll stay here for a few minutes if you have any questions. Thank you again. Oh, by the way, if you're still on, you're going to be getting a questionnaire. Someone asked last time. It's sent out by Zoom after. So the only thing I need from you now is your certificate. Anyway, I'm going to turn this off now. It seems like there are no questions. Again, have a good afternoon. Thanks. Bye.